Hello and welcome back to the channel here. Today is part 44 of international taxation, and as far as I plan, it's probably the last part of this lecture series. Well, um, some last remarks we have still to make about what can we observe as ongoing new tendencies in the field of international taxation. Because there are some things going on which are fundamentally new and which result in the last consequence, or which form in the last consequence a consequence of international tax planning efforts and possibilities of internationally active enterprises. Let's begin at the beginning. We have seen already that when there are two different tax rules for the same thing, then the taxpayer who is a bit of intelligent will always choose the more advantageous behavior, and so people will do tax planning. Now, when you want to stop that, that only stops if you can remove the differences so that you have no choice, but irrespective of what you do, you are taxed in the same way. Now, when we have an international playing field, then there will be always different possibilities available because two states have different tax laws, so different tax rates or different tax base definitions are always available. The only thing you need is to shift your activities or perhaps even only your money to another country. And traditionally, states then try to remove the differences by, as we have seen, CFC legislation or deduction limitations. So by extra rules which increased your tax burden in the country. However, during the last decades, that seems no longer to be sufficient. A new tendency has begun to build itself up. Because states have now begun to force other states to change their tax laws too, in order to fit better into their own system. So there is a tendency towards a uniform tax legislation on the worldwide level. However, these are the very, very first beginnings. But it's fundamentally new. 50 years ago, every state had the idea, I'm sovereign, I can write my own laws. You had the idea, well, the others are sovereign, they write their own laws, we can only react. And if there are tax saving opportunities, well, we try to counterattack by introducing additional tax burdens in our country. However, some 20, 30 years ago, the industrialized states said we want to get a grip on all that money from private investors, which is invested and hidden in banks in tax havens. So they said we must end the non-cooperation and the possibility to commit tax fraud by hiding money in savings account in foreign banks by exercising economic pressure on the tax haven countries. And what was new at that time was that the industrialized states made an agreement. If a state does not comply and does not give us information on which bank accounts exist in its territory, then we are going to exert coordinated pressure of all industrialized states on these tax haven countries. So you might call it a trade war by all the important economies of the world on a small little statelet in order to force them to comply what we regarded as wishful behavior, wanted, desired behavior in the field of taxation. So it began with the pressure, tell us information about the bank accounts of private investors in your countries. If you don't do, then we bring you under attack and sanctions. So the pressure was to share certain information on bank accounts or so with the tax authorities of other countries where the investors resided. Within a relatively short time, that began to function. And systems were set up where a huge amount of cooperation between the fiscal authorities was enforced effectively. The Americans introduced that famous FATCA regime, which definitively forced either all states of foreign banks or the foreign banks to cooperate with the American fiscal authorities and exchange all information on American bank account holders in these countries. And other states began to use that system too. So nowadays it's highly implausible that you can open up a bank account in a, let's call it, civilized or semi-civilized country, if that exists, and still manage to keep that bank account undetected by your home state. Then exchange of information was afterwards or at the same time often established in an automatic way. So in former times it was only on request. Nowadays the fiscal authorities more and more agree on automatically to work together. So when a fiscal authority gets some information about, let's say, a bank account or something else, let's say a salary paid to you in a certain state of the EU, automatically the information also goes to your state of residence. Then the big firms were forced to make country by country reporting. That is to disclose what money they earned in which countries, which customers they had where, and similar data, so that the tax authorities of all the states involved can get an overview how much money is earned in which state and how much tax is paid there. And in the end, you had a change of mind. In former times, it was a kind of sovereignty and a characteristic of sovereignty that a foreign state did not need to cooperate. Nowadays, it is rather the official and public expectation that the fiscal authorities of one state have to cooperate with the fiscal authorities of the other state, and it's even necessary, or if you don't do, then you need to justify that refusal, in contrast to former times. If you refuse and it doesn't convince the international public, you might face economic countermeasures, probably sanctions or a trade war. So states can no longer afford in practice to insist in their sovereignty in that area. Practice has enforced the need to cooperate with the tax authorities of other countries. There have even been public statements, for example, referring to CBCR reports. When we bring that project forward, that will probably not be to our advantage financially. However, we can't afford to refuse. Otherwise, we come under too much pressure from public opinion in all the other states of the earth. So we need to do it and to hope the very best that we can also have the one or other moment when we profit from it. That was a statement of some representative of a German Bundesland fiscal authority at a conference some 10 years ago already. I don't know exactly. So that's one thing. Then unfair tax competition is something which has become a word and an officially recognized phenomenon. You know that states have become aware more and more of the fact that taxes are also a factor which can make a location attractive or less attractive for investment of foreigners. So very often they have detected that they can take part in something, or that something is going on which they call tax competition for investments. So the idea is you lower your tax rates and then you make yourself more attractive to foreign investors. So most states did try to do this. Americans lowered their corporation tax under Trump from 39 to 21%. Germany went down during the last 30 years from 56% to 15% corporation tax nowadays. And similar things. So there is a general tendency to lower tax rates in order to make yourself more attractive, at least in the business sector. However, very often a state nowadays faces a problem. We want to become more attractive for foreign investors. However, if we go on lowering the tax rates for our businesses in general, then we lose so much revenue from the small and medium enterprises that this is too expensive for us. So what we want to do is we want to grant attractive lower tax rates only for investments of foreigners which come newly into the country, and we want to go on demanding those nice high tax rates from the ones which are already here. Now that's not nice. Um, Special offers, let's say, to foreign investors. Ideas how that was propagated or tried was reduced tax rates for a sector of economy which until now not does exist in your country, so you do not lose money if you lower the tax rate there, or tax holidays. Let's say newly founded enterprises during the first 10 years of their existence do not pay taxes, or subsidies for investing here in covered or open form, and all this happened. The new tendency after a while was other states complained about this, and you could observe that an international convention formed itself that tax competition, okay, is natural. However, it should be fair. That means that special offers to foreign investors should not be granted. And if somebody grants such things, then this is unfair, illegitimate, and should be fought against. So either you lower your tax rates or your taxes equally for all people involved, or you keep your taxes high, but you should not allow cherry picking for foreigners. So the international public nowadays demands or expects that special tax privileges and subsidies to certain enterprises should not exist in a foreign tax jurisdiction. And if a tax jurisdiction creates these things, then it's regarded as adequate to react by sanctions against that foreign state. It's a question then how diplomatic you can do that. However, again, if it is possible, they try to react in a coordinated approach of all industrialized or all important countries. So um, states begin to agree we all fight if somebody doesn't play according to what we now regard as the rules of fair tax competition. So we have an evolving international rule which says a state can now demand or expect that another state does play according to rules which they all silently have agreed upon, or where most of the states think these are the rules which should be followed, and we expect that everybody follows them. Otherwise, you get beaten up, so you get sanctions and other things. Or get the subject of economic sanctions in the tax area or outside the tax areas. So we expect that other states do not grant tax subsidies and other tax privileges for selected enterprises. If you do it, nevertheless, it's regarded as legitimate to force you to comply. And we nowadays see that this is then not a violation of the sovereignty of the foreign state. One sees it as necessary and a legitimate measure. That's new. Now, recently, even another problem has shown up, which we have not yet discussed and will probably not. No, we will not discuss that in the course of this lecture, because that's too complicated for beginners and those who were beginners, so principally for everybody. The question which showed up was if a payment is qualified differently by one state and the other, then it can happen that the one state says this payment is a business expense, so they deduct it from the profit and it lowers the profit. So it leaves the amount is not taxed as a profit, so it leaves the state untaxed. However, in the other state where it ends up in the hands of a recipient, there it is not seen as a taxable revenue, however, but perhaps only as a withdrawal or a mere transfer of money from bank account to the other, so it does not cause a tax in that state either. So imagine you earned 1 million in state A, then you made such a payment which is differently qualified. So your profit in state A is lowered by a business of 1 million to zero, and in state B you get 1 million. However, it does not count as taxable profit, so there the tax is also zero. And the consequence is then what is called white income, legally untaxed income, the worst fantasy of the fiscal officers. You can earn money in a legal way and nowhere tax is claimed. Now, that was theoretically always possible in former years. However, with the internet, with multinational tax advising corporations, with the possibilities to gain information nowadays, constellations of these kind have been systematically analyzed. You can nowadays look for these mismatches, which follow from a different qualification. Sometimes people call them hybrid, Greek for mixed mismatches. These hybrid mismatches, people looked for it systematically, asked experts from countries. You can assemble these people on conferences, you can do it by Zoom calls and other things, and afterwards you can confirm, okay, if I transfer, let's say, 10 million from country A to country B, that will lower the profit in country A, so I don't pay taxes on 10 million there, and it will trigger no tax in country B. That had considerable success, and the practice spread more and more. It's complicated, okay? It's probably expensive to do the research for the information. However, once you have found such a possibility, you can use it for hundreds of millions, so law must be changed afterwards. And that happened more and more in individual cases. However, states have recently agreed in the course of all that BEPS fighting project to undertake measures to avoid these hybrid mismatch constellations by establishing a rule which demands a kind of corresponding treatment of payments in both states, which means nothing else that if a payment is qualified as a business expense in the other state, it should be not left tax-free in the other state. For example, if something is seen from us as a dividend, it should be tax-free in our country under paragraph 8b or partially tax-free under 3 number 40, then we should make that subject to the condition that this dividend, the underlying profit, was also taxed previously on the level of the paying company. If not, the consequence should be no business expense in the one country, no tax exemption in the other country. So deduction must entail taxability in the one or other form in the other country. These rules shall at least be applied by everybody if payments are made between two related companies, because that is where it can be most successfully exploited, because then you just shift money from one pocket to the other pocket within the group. However, you achieve a tax effect and generate white income, so at least there it should be attempted. And why is that new? That agreement that hybrid mismatches should be avoided. The new effect is now when a state sets up its rules for the determination of the tax base. Traditionally, it was completely independent. And nowadays, you establish an international agreement which says, yeah, you can define your tax base as you wish. However, there is one fundamental requirement. A deduction in the one country shall preclude any tax exemption in your country, and things like that. Or if a deduction can be claimed in country A, it cannot be claimed for the same amount in your country a second time. So a payment of 1 million shall not be differently qualified in a way that it in the end can twice be deducted, although it has only been once paid. Things like that have been established. So this leads For the first time, we know for a binding obligation to design your tax base no longer completely on your own, but in correlation to what others do. Fundamentally new. Um, your independence here has now been restricted by an international conviction that white income should not exist, and that everybody has a moral obligation, at least, to prevent it. Furthermore, there is another thing going on. Traditionally, states made bilateral agreements, double taxation treaties. Two countries meet, negotiate, take a while, talk 5 or 10 years over a question, then write a treaty. That treaty can easily be cancelled or changed or amended afterwards. And there was always that principle which was held in high esteem or high ranking. We should not bind ourselves to international conventions. There should be no unwritten worldwide law of civilized nations which binds everybody. So we take great care that we say every rule on the division of taxation rights is individually agreed. It's purely bilateral. There must never be an unwritten convention which might be binding on all states by general conviction, even if you don't sign a treaty, so that there is a public pressure. It was always pretended this can always be made bilateral. And nowadays, more and more questions have to be agreed on by most all important nations, and more they take refuge to we need a multilateral treaty. We need an immediate solution in a treaty between 60, 70, or 100 states, or even more, which then sign and take the binding obligation to follow the rules here. Naturally, these rules which you establish there can then probably never be changed, and that established also a strong pressure for all other states of the earth to comply. If, let's say, 140 states of the earth agree on a common set of basic rules, it is practically impossible to set up a different system in the rest of the world without, let's say, generating a conflict worldwide. If 140 states of the earth agree on a certain set of rules, and you are the one state who doesn't comply, you will not have success in setting up a different system which has a comparable influence or so. You are just lost. You have to comply or stay out. And more that happens. We had, at the end of the BEPS project, there was, for the first time, the official announcement. We are all aware that the transformation or the legal transformation of the BEPS principles can only be successful if we sign a multilateral agreement of 70, 80 or more states. So all states taking part must sign one and the same treaty, because otherwise this would never work. And nowadays BEPS 2.0 is going on. There is a plan that there is a complete redistribution of the taxation rights, and this redistribution of taxation rights must be coordinated on the worldwide scale. So you have to override again all existing double taxation treaties now with the same contents concerning the multinational enterprises. So I believe it's thought of to establish a multilateral convention on these rules. So the so-called Pillar 1 rules. And that shows again, countries need more and more uniform rules on a worldwide level. And that's completely new. So that trend might go on in the future with more and more questions coming up newly, where international cooperation and the intensity of international cooperation and trade and so on, the possibilities to have tax planning there or to react to different tax laws, that all that forces new solutions to come up. So things which traditionally were always held to be true, there are sovereign states and things like that, come under pressure now. These concepts do no longer fully work and are replaced step by step by more and more other kind of rules. So fundamentally different things, fundamentally new things are going on. So we can say that we live in fascinating times. As somebody in history said to, I believe it was somebody at Valmy in the French Revolution, he said, now and here a new time began or begins, and later you can say you have been here at the moment when it began. And the same is probably true in the field of taxation and in many, many other fields of law. In our times, completely new things are beginning. And we can later say, however, the question is to whom we can say later say, we have been there when it all began. So I hope that you enjoyed the introduction to international taxation a bit. I would like, or really be happy if you also take a look at the one or other lecture which I offer on my channel. And I thank you very, very much for watching all this so patiently. Recover well and enjoy your life. And I hope new things also begin in your life, which lead you to good results and a good, happy outcome. Thanks very much for watching. Hope to see you again at another location, so in another of my video lectures. And all the best to all of you. Thanks and goodbye.